This LOS is calculate and interpret the following multiples: price to earnings, price to an estimate of operating cash flow, price to sales, and price to book value. Okay, a quick review of the ratios. The PE is the price per share and the earnings per share. So note that everything's on a per share basis. Price to cash flow is the price per share to the cash flow per share. Price to sales is the price per share to the sales per share. And the price to book value is the price per share to the book value per share. Okay? So we'll start with a practice question that asks to calculate the price to book value of a company. So an analyst gathers the following information about a company: common stock, $1.50 par value, authorized is 5 million shares, issued is 4 million shares. Additional paid in capital is 20 million, retained earnings is 5 million, treasury stock is 500,000 shares, and that's $10 million, and the current price per share is $21. The price to book of the company is closest to A, 2.31, B, 3.5, or C, 4.2. I really like this question because most candidates don't get it right the first time. It brings back some of the accounting and some of the corporate finance that we did, because it's this issue with regards to the treasury shares. Okay, you need to be very careful. So when we're looking at the number of shares issued and outstanding, we had the 4 million, but we got to take off the 500,000 treasury shares. And most people, you're probably hitting yourself saying, aha, yeah, I forgot, especially if you're working too quick. So it's 3.5 million is on the number of shares that you need to use. And then for the book value shares, you got to do 4 million shares, which are issued, times the $1.50, plus the 20 million additional paid in capital, plus the 5 million retained earnings, but then again take off the treasury stock of 10 million. So in our numerator, the book value per share is 21 million, and our denominator is 3.5 million shares. So you get $6 for the book value per share. So the price to book value is going to be the 21 divided by 6, and you're going to get 3.5 times, which is the correct answer is B. So a nice little question, not too difficult. It's one of these that once you've seen once, fool me once, shame on you, fool me twice, shame on me. You'll say, aha, I need to remember now how to calculate my book value per share and what I need to do with my treasury stock. Excellent little question. I give that one a 5-star. Okay, here's another practice question. An analyst has prepared a table of the average trailing 12-month price to earnings PE, price to cash flow, and price to sales for the Tanaka Corporation for the years 2005 to 2008. So you can see on the rows you've got the years, on the columns PE, price to cash flow, price to sales. I won't read them all. As of the date of the valuation in 2009, the trailing 12-month PE, price to earnings, price to cash flow, and price to sales are respectively 9.2, 8, and 2.5. Based on the information provided, the analyst may reasonably conclude that Tanaka shares most likely are A, overvalued, B, undervalued, or C, fairly valued. Okay, this is another one. When you see the solution, you think, oh, that's so easy, because sometimes you're thinking, I don't know what I don't know. What kind of complicated calculations do I need to do? But in this case, all you had to do was the average, which is the sum of the numbers divided by the count of the numbers. So you did an average for the PE, an average for the price to cash flow, and an average for the price to sales, and so what you or price to revenue there, and compare it against what the numbers are now. So 9.2 is greater than 7.1, 8.0 is greater than 7.3, and 2.5 is greater than 1.7. So it says A is correct. Tanaka shares are most likely overvalued. As the table above shows, all the 2009 multiples are currently above their 2005 to 2008 averages. So again, we've talked about sometimes the reversion to mean. If the averages, the multiples are above the long-term averages, it's going to come down. You're overvalued. If it's below, perhaps it's undervalued. It's going to be reverting to the mean. So a nice little question. Another practice question. The issue of differences in accounting conservatism between companies is best addressed when companies are compared using which of the following ratios: A, price to earnings, B, price to cash flow, or C, price to book value. Okay, this is an easy question for you accountants out there, because you know the issue about professional judgment, okay, and accruals, etc. Earnings can be managed a little bit. So the correct answer is B. Using price to cash flow rather than price to earnings addresses the issue of differences in accounting conservatism between companies and differences in the quality of earnings. Okay, again, earnings and book value through different accounting policies and estimates and conservative versus less conservative approaches can be affected, but cash is cash, so therefore price to cash flow would be the correct ratio to use. Another practice question following along those lines. Among a company's price to earning, price to sales, and price to cash flow ratios, it is most accurate to state that PE ratios are generally more stable from period to period than A, price to sales ratios but not price to cash flow ratios, B, price to cash flow ratios but not price to sales ratios, or C, neither price to sales nor price to cash flow ratios. Okay, that's a question that makes you say, aha. So the correct answer is C. Both sales and cash flow tend to be more stable than earnings, making the multiples based on sales and cash flow more stable than those based on earnings per share. Nice little question. Once you've seen it once, you won't forget it. Okay? And one last practice question to finish this LOS. Which of the following is the least accurate rationale to justify the use of price to book value, PB ratio, as a measure of relative valuation of companies or common stocks? A, price to book is a useful measure of value for firms that are not expected to continue as a going concern. B, compared to price to earnings, the price to book ratio is not influenced by such accounting effects as expensing a capital investment as opposed to capitalizing it. Or C, price to book is particularly appropriate to value companies primarily composed of liquid assets, for example, those in the financial services industry. Again, the trick here, they're looking for the least accurate, so when I see that, I'm going to underline it, I'm going to star it, and I'm going to say I'm looking for the false, okay? Because when we're looking at price to book, if you read A, price to book is a useful measure for firms that are not expected to continue as a going concern. Yeah, we've talked about that many times. That's true. We're not going to use free cash flow to the equity or dividend discount because it's going to be liquidated. Price to book is particularly appropriate to value companies primarily composed of liquid assets. Yes, we said that's also true because it's not appropriate if there's a lot of intangibles which are hard to calculate. So therefore, B must be the false and therefore the correct answer. So it says compared to PE, the PB ratio is not influenced by such accounting effects. Yes, it is influenced by accounting effects. Again, the accountants will get that one right. Price to book ratio is influenced by accounting effects such as expensing, because assets equals liabilities plus equity. If you're going to expense versus capitalize, that's going to affect your assets and your liabilities, etc. Okay? So that's the last slide for this LOS. Thank you.